Chapter 4. It's gonna get easier here. Primarily, this chapter focuses on cash. And we're going to learn how to reconcile a bank account. How many of you guys have ever reconciled your checkbook? Do you know you're not alone? It's amazing how I've been teaching since 2008. Honestly, since 2008, maybe 3 or 4 people have raised their hand. Do you know how many classes I've taught? So we just assume the bank doesn't make mistakes, but they do, guys. They do make mistakes. So we're going to talk about internal controls. Why do we need to have internal controls within a business? For errors aren't intentional. Errors are accidents. Accidental errors in recording transactions, or possibly even applying the accounting principle. You know, an error could be we purchased a $6,000 piece of equipment and we treat it as an expense instead of an asset. That's an error, but it does affect the financial statements. Fraud, on the other hand, what we were looking at today, is a person that intentionally deceives another person for personal gain or to damage that person. The difference in error is unintentional. Fraud is intentional deceit. Okay? Occupational fraud is the use of one's occupation for personal enrichment through deliberate misuse or misapplication of the employer's resources. So the slide we were looking at earlier, can you see that was occupational fraud? Because of that individual's position in the company and in society, he was able to deceive to benefit for himself. Now, whatever you want to call it, he was supposedly the one guy, lending someone money and giving it back. It wasn't his to lend and give back. Okay? Here is a really huge piece. For fraud to exist, there must be 3 components in place. I just find this is true. Opportunity. Opportunity is one thing a company can stop. Motivation and rationalization are on the part of the fraudster. You know, however they choose to rationalize their behavior is theirs to live with. There's got to be some need. Motivation can sometimes be called need. There's something that is driving the yearning to commit the fraud. It could be they have true medical bills that are genuine. I had there was a church down in the southern suburbs, and I don't want to go into say too much, but there was a lady that was the secretary of the church secretary. Her husband worked for an airline as a pilot. He made very good money. So it's not as though there was a need to pay bills. And she was the church secretary for years, and they ended up finding she swindled like $250,000. Now, they didn't press charges. They paid it, you know, her husband and herself, they paid it all back. It got exposed. They paid it back. They chose not to press charges. I don't know the right answer for that. But why would she steal? Well, you come to find out she had a gambling problem that was secret. I mean, sometimes we all have secrets. But you see how our secrets can make us sick. So in this example here, opportunity is the situation allows the fraud to occur. That is the only thing an employer can try to control. You can't control the motivation. Someone feels the need to commit fraud. For whatever that need is, you can't control that. The rationalization is the justification for the deceptive act, such as, they're not going to miss it. Oh, I'm just borrowing it. You know what? I'm not getting paid enough for this shit. Or, whatever the thinking is, for fraud to occur, all three have to be in place. But the only one that the employer can control is the opportunity. So it can't even happen. Okay? Internal controls attempt to eliminate the opportunity element of fraud. And what the goal with internal controls is to protect or safeguard the company's assets and to improve the accuracy and the reliability of accounting information. That is why we have internal controls. Safeguarding the assets and helping to improve the reliability and accuracy of the accounting information that's being put out. Now, without going into a lot, back in 2002, which is what I'm going to post for you, some of these crazy frauds, there were a series of frauds. Was it just starting? Hell no. It's always been around, but so many big ones happened all at once that it made Congress have to make some laws. And so what happened is, as a result of the Enron and WorldCom, and those were the two really big ones, Congress had to create some laws. Enron and WorldCom were big frauds. And as a result, an act was passed called the SOX Act, Sarbanes-Oxley, SOX. And it basically established guidelines related to auditors giving an opinion on the internal control procedures within a company. And it also changed guidelines related to auditor-client relationships. So public companies must be audited every year. And you really want independent auditors to audit a company. But things were getting really skewed. Arthur Andersen had was a large auditing company that is no longer in existence as that. They're now consultant, but they do not do income taxes or any auditing anymore. And they were really benefiting from helping to perpetuate or hide the fraud that was going on. So two things were affected by the Sarbanes-Oxley Act. They had different things, but the biggest thing was related to internal controls that we care about. The company's management is required each year to document and assess the effectiveness of their internal controls, and that the company's auditors have to express an opinion on whether they think management's assessment is effective. So it's management who's responsible for providing internal controls, and all the auditor does is express an opinion on it. Remember, everything is management. They run the company. They're responsible. So, which of the following statements is not true about the Sarbanes-Oxley Act of 2002? All correct. Not all companies. Private companies are not required to adhere to one. If you're dealing in the stock market and the public can invest in your stock, you're held to a higher standard. Makes sense, doesn't it? So only public companies are required to adhere to the Sarbanes-Oxley Act. So as far as internal controls, let's think of it in this way. We start out with a control environment. That control environment sets the overall ethical tone of the company with respect to internal controls. That's going to have policies related to management's philosophy, the responsibilities and who is responsible for specific items, and an organizational chart that really sets into motion the levels of control and who's responsible for what pieces of an organization. That's the base of internal controls. From there, risk assessment is important for each company. Each company has its own types of risk. A risk assessment identifies and analyzes any internal and external risk factors that could prevent a company's objectives from being achieved. Think of a casino. What is the first thing that comes to your mind when you think of a casino? Lots of money are going through hands. Because of that, they need to look at their internal controls, and based on their risk of having cash go through. Have you guys noticed in airlines, they no longer allow you to pay cash for drinks? You have to have a debit card or a credit card if you're in an airplane to get to get a drink or any food. Why is that, you think? What? Cash. Cash is a huge risk item. Now, no more cash. Guess what they're doing? They're eliminating that risk. Now, I've heard at the Mall of America, a lot of the the food places are doing the same thing. Have y'all heard that? I haven't been there, but I've heard a lot of the food places in the Mall of America don't allow cash anymore. Smart idea. I mean, it's a trade-off. Credit cards have fees associated with them, but a heck of a lot cheaper than money walking out the door, right? Control activities. So once you see the risks associated with your specific company and industry, then we need to put into place control activities, which are policies and procedures that help ensure that management's directives are being carried out. These activities include authorizations, reconciliations, and separation of duties. So, for example, a control activity at this college, I don't have the ability to just go and buy a new computer for myself. I don't get that privilege. And so usually, and I can't even tell you who does, but I'm sure a dean can get that privilege. You know, everyone's allowed to spend so much money. That is a control activity. I need to have someone sign off or authorize a purchase that I choose to make. Does that make sense? Reconciliations. In this example, in this chapter, we're going to reconcile bank statements to make sure, in fact, what occurred is, in fact, what we show truly happened. And separation of duties is key. Now, guys, when you've got bigger companies, it's very easy to have separation of duties. But in smaller companies, there's a problem with that because you don't always have the feet or the hands to separate duties. After you have these control activities in place, it's important to monitor them. You have to continually monitor these internal controls to make sure they're working. You can't put them in place and ignore them. You got to keep checking to say, hey, is it happening? Are they working as we anticipate? So, for a movie theater, they might have various controls such as separation of duties. Employees selling movie tickets shouldn't account for the cash at the theater. That makes sense. Or concession supplies should be kept in a locked room with access allowed only to authorized personnel. Or proper authorization. Theater management should be authorized to make purchases over a certain amount. Or with employee management, employees should be made fully aware of the company's internal control procedures, their ethical responsibilities and channels for reporting those irregular activities. And then e-commerce controls. That's a whole nother animal when we're dealing with online, right? whole nother animal. And then detective controls, so those here are preventative controls. Detective controls, preventative controls try to stop anything from happening. But detective controls, the plan is that we will learn of things that have gone awry. Reconciliations, do the physical assets match what we say are on the books? And performance reviews. And finally, audits. Bottom line, with the Sarbanes-Oxley Act being passed, the CEO, the main head honcho of a company, and the CFO, the financial officer of the company, yearly for public companies must sign a report that certify adequacy of internal controls. Now, guys, and then they're responsible personally for these fraud. Has it changed? Do you think that all of these acts, the laws passed, have changed fraud? Still happens. But again, it puts some boundaries in its place. Okay? So guys, what do you think here? If a company places cash receipts from a day in a safe or bank deposit box, would this be an example of A, separation of duties, B, physical control, C, reconciliation, or D, performance review? Physical control. Okay? Cash receipts from the day in a safe or bank deposit box, at least the money's being secured. Okay? So here we've got 9 different items. And we're just kind of going to go through these right away, if that's okay. So the components, below are several statements. Is it true or is it false? The components of internal control are built on a foundation of the ethical tone set by top management. Guys, have you ever worked at a company and it's just scum? Like you feel it, it's like, I don't care what the rules are, you make money no matter what you make. You feel it. Or you have an attitude, you go in and it's like, we're gonna do the right thing here. We're gonna treat people right. We're gonna work honorably. Do you guys know what I'm saying? You feel it. That's the control, that's the ethical tone that comes from top and goes down. How about this one? Once every, here's the key kicker, 3 months, managers need to review operations to ensure control procedures work effectively. No. Once every week. Or, do you get what I'm saying? Not every 3 months. Okay? Do you understand where that's off? It needs to happen more often. I did not talk about collusion, but collusion is when 2 or more people come together to defraud a company. It's harder. It's one thing when someone's trying to act on their own, but when 2 or more people are coming together, it's sometimes even harder to catch because they can have different separation of duties that are coming together. Does that make sense? Detective control procedures are designed to detect errors or fraud that have already occurred, while preventative control procedures are designed to keep errors or fraud from occurring in the first place. That is correct. Fraud committed by top-level employees is more difficult to detect because those employees have the ability to override internal control features. Absolutely. They're the ones that create them. They can override them. Fraud, oh, yes. A good example of separation of duties would be having one person collect cash from customers and account for it, while having another person order inventory and maintain control over it. No, the person who's collecting cash shouldn't be the one that's accounting for it. And the person that's ordering inventory shouldn't be maintaining control over it. You should have 2 separate people involved in that. Okay? Guys, this is true. Employee tips historically have been the most common means of detecting employee fraud. Do you know the IRS hotline, whistleblowers, or that's how the IRS catches most of people. Disgruntled spouses, disgruntled employees. Detective controls, including reconciling the physical assets of the company with the accounting records and comparing actual performance of individuals or processes against their expected performance. That's correct. Okay, this last one, guys, is a trick question. Effective internal controls and ethical employees ensure a company's success. Do you think that's true? No, you need a heck of a lot more than just good internal controls. You need a product or a service people want at a good price, blah, 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 blah. Okay? Is that helpful, guys? So there are limitations on internal controls. If you got a bad employee, guys, and you get some internal controls in place, it's not going to turn a bad employee into a good one. Just get rid of them. Internal control systems don't help with collusion a lot of times because you got people from different departments that could come in together. Does that make sense? Top-level employees who can override internal control procedures have more opportunity to commit fraud. It just makes sense. They have the wherewithal. Okay. So we're going to look at this one. There are different controls. We talked about separation of duties, physical controls, authorizations, employee management, reconciliations, performance reviews. Here, we're supposed to look at these control activities and determine which control activity got screwed up here. So a manufacturing company compares total sales in the current year to those in the previous year, but does not compare the cost of production. Performance reviews is basically what got messed up in this case. They need to have performance reviews to compare how sales match to goods. That's something you're going to be look more into if any of you take managerial accounting. So that employees have easy access to office supplies, a company keeps supplies in unlocked cabinets. Well, physical controls are being violated there because anyone can just come and take it whatever they want. Does that make sense? At the end of the day, a single employee collects all cash received from the customer, records the totals, and makes the deposit at the bank. Separation of duties is the violation here. Really, they should have a couple different individuals doing those separate jobs. At the end of the year only, the company compares the cash records to the bank's records. Those reconciliations should happen monthly, the bank reconciliations. Don't wait and do 12 at once. A company encourages employees to call an anonymous hotline if they believe other employees are circumventing internal controls. Nothing's being violated there. That's a good idea. All employees to have the authority to refund a customer's money, not good. There should just be certain select people that have that authorization to do so. Correct? So, the reason we're talking about internal controls is because cash is a huge risk item. Cash and cash equivalents can be coins, checks, savings accounts, checking accounts, credit card sales, debit card sales, and cash equivalents. It's not just a green dollar, okay? Which of the following would not be considered a cash equivalent, guys? What do you think? I'll help you on this. Cash is a current asset. D is not a current asset because D isn't going to be matured for a year, right? Correct. So, collection of payments from customers. We receive payments via cash and checks, via credit cards. Now we get online payments too, electronic fund transfers, prepaid cards. I don't really deal with cryptocurrency, and they're really trying to put a hold on that. But that is in this new day and age, isn't it? So how can we go about having controls over cash and checks? The person who opens the mail each day makes a list of the cash and checks received, including the amount and the payer's name. That's a good control. You designate one employee to deposit cash and checks into the company's bank account each day, different from the person who opens the mail. Then you have another employee record the cash receipts in the accounting records. And you make sure the cash receipt, you compare the cash receipts by comparing the bank deposit slip with the accounting records. Accept credit cards and debit cards to limit the amount of cash employees handle. That is happening everywhere. That is an effective control. The acceptance of credit cards provides an additional control by reducing employees' need to directly handle cash. Meanwhile, the credit card company deposits the cash in the company's bank for the amount of the sale less service fees. You know, I think, some people pay 1.8%. I've had some clients that are up to 7%. That's a lot of money. Those squares are great, but that costs a lot of money. Everyone's got different fees. So, for example, a movie theater accepts MasterCard as payment for $2,000 worth of movie tickets, and MasterCard charges the movie theater a service fee of 3%, which is $60. Here what would happen is cash would be debited for $1,940. We would debit the service fee expense for $60, and the service revenue of $2,000 would be get credited. Does that make sense? Debit cards are like credit cards. They allow customers a way to purchase goods and services. They differ in that most debit cards work like a check and withdraw funds immediately from the bank account. Similar to credit cards, the use of a debit card results in a fee being charged to the retailer. So even though it's a debit card and it gets deducted immediately, they still charge you a fee to utilize those credit cards. Next. The term debit card can cause some confusion for someone in an accounting course. Throughout this course, we refer to an increase in cash as a debit. However, using your debit card will result in a decrease in your cash account. The term debit card refers to the bank's liability to the company being decreased, debited when the company uses your debit card. So just know, debit card is for the purposes of the bank's visual, or the bank's perspective. When they debit your account, they're taking money out of your account. None of it's theirs. Your account isn't their money anyway. So it's a liability on the bank's books. So think about it. You put $10,000 in your checking account. The bank debits cash of $10,000, credits a liability, your account, for $10,000. But then when you use your debit card and take out $1,000, the bank is debiting your account, aren't they? For $1,000. So how can we control disbursements? Make all disbursements, apart from small amounts, by check, debit card, or credit card. Authorize all expenditures before purchase and verify the accuracy of the purchase. The employee who authorizes the payment shouldn't be the one who writes the check. Make sure checks are serially numbered and signed by those only that are allowed to sign checks. Periodically compare amounts shown in the debit card and credit card statements with purchase receipts. The employee verifying the accuracy of the debit card and credit card statements should not also be the employee responsible for the actual purchase. Just keep them separate. Set maximum purchase limits on debit cards and credit cards. Get approval. Employees responsible for making cash disbursements should not also be in charge of cash receipts. Okay? I do a lot of people's taxes, and I'll do their books. And a lot of times, clients will ask me, I want you to pay all my bills. We will never sign a check. First of all, I don't want that risk. I don't want that responsibility. And secondly, I want to always be clean. And so don't even put me in a position, or I won't let myself be put in a position where that can happen. So, for example, we do these, one of my girls in the office usually pays the bills. She was gone for about a month and a half, and they owe me money. But I wasn't even going to allow myself to even write the check that shows they owe me. I wait till someone else comes back and does it. Why do I do that? It just keeps me out of the loop so I can never be accused of doing anything wrong. So in this example, a movie theater pays $1,000 to advertise its showtimes. The movie theater pays with cash, a check, or a debit card. Either way, all of that's cash, isn't it? So you would debit the advertising expense and credit your cash. Or a movie theater pays $1,000 to advertise its showtimes. The movie theater, purchase advertising with cash, check, or a debit card. If you pay with, record purchase of advertising with a credit card. If you pay with a credit card, then you would debit the expense and credit the payable. Because remember, cash, check, or debit card happens immediately. A credit card's going to happen, you're going to pay it at the end of the month. Remember, guys, because cash is the asset of a company most susceptible to employee fraud, controls over cash receipts and cash disbursements are an important part of a company's overall internal control system. Important controls over cash receipts include separation of duties and independent verification of cash receipts. Also, no over cash disbursements. There's separation of duties, authorizations, following various procedures when handling disbursements. So here are, on this screen, you can look back. This is in the content section of D2L. Look at these cash controls in case you're asked this on a quiz. Okay? Here's what we're doing today. We're reconciling a bank statement. The balance of cash in the company's records probably won't equal the balance of cash in the bank's records. And so we use a bank reconciliation to match the balance of cash in the bank with the balance of cash in the company's own records. There are going to be discrepancies. And those discrepancies are all about timing. Maybe something's hit the bank that the company doesn't know about. Or maybe the company's written a check or made a deposit that hasn't hit the bank yet or cleared the bank yet. Okay? So all of this is about timing differences. Why we need to reconcile a bank statement. Oops, sorry guys. Okay, so here you see the account records of a company. You see their cash receipts and you see their cash disbursements. So you see different dates with the sales they had. Then the disbursements, you see debit card, electronic funds transfers, and checks. So different ways of dispersing monies. So for the company, we've got $35,900 of cash receipts, $24,900 of disbursements. We started the month with $23,600. So we should have at the end of the month $34,600. Okay? That's what should be at the end of the month. Or that is what we have at the end of the month. Here is the bank statement. The bank statement shows their balance at the end of the month is $26,400. So we need to reconcile the two to see where we're at. Okay? You see what's come in through the bank and what's gone out through the bank. Now, just so you know, there's some things that have come in here through the bank the company wouldn't know about. This $200 interest, they probably haven't recorded that yet, have they? Or, do you see this service fee of $2,800? They're probably not aware of that. Or here's an NSF, a non-sufficient funds, which means a customer wrote a check, the company deposited it, but it wasn't good, meaning there were not enough funds in the customer's account. Therefore, the check was sent back to the bank. Does that make sense? They might not know about that yet. So, notice that bank statements refer to an increase or deposit in the cash balance as a credit and a decrease or withdrawal as a debit. The terminology is the opposite of that used in financial accounting, where debit refers to an increase in cash and credit refers to a decrease in cash. Remember, you have to realize why they're doing that. From the bank's perspective, your money is a liability to them. When a company makes a deposit, it views this as an increase to cash, so it records a debit to cash. But the bank views this same deposit as an increase in the amount owed to the company or a liability, which is recorded as a credit. Okay? Does that make sense? Reconciling a bank account involves reconciling the bank's cash balance, reconciling the company's cash balance, and then we'll update the company's cash account by recording items. No, items that the bank recorded that the company has not yet recorded. We need to do journal entries to make sure our books balance. If the bank made an error, we don't need to fix that on the company's records because it's the bank's error and they're going to fix it on their own. It won't affect us. But if we've made an error, we need to correct that. Okay? So, we'll first start by reconciling the bank's cash balance. We're going to do that by cash transactions recorded by the company but have not yet been recorded by the bank. That's going to be deposits that are outstanding and checks that are outstanding. So if the company shows a deposit, but the bank hasn't received it yet, that would be a deposit outstanding. Or if companies have written checks that haven't cleared the bank yet, that would be a check outstanding. Does that make sense, guys? Yes? Excuse me one sec. I apologize, 1 second here. Okay, then what we'll do is see if the bank made any errors. And if the bank made any errors, we're going to notify them of that. So here you see the company's records are on one side, the bank's records are on another. Do you see we've got this $3,600 matches. The $5,900 matches. The $4,200 matches. The $7,400 matches. The $6,300 matches. But do you see this $8,500 has not hit the bank yet? And look over here. The bank shows a note of $2,000 that hasn't been recorded in the company's books. And the bank has $200 worth of interest that hasn't been recorded. So we know what we need to fix on both sides. We're going to need to, on the company side, record these items that haven't hit the company yet. And we know the bank has not yet received this $8,500 check deposit, have they? So, you see, look at cash payments. The salaries happened. The rent occurred. Oh, look there. The company said the advertising was $3,000, but clearly the bank showed it to be $3,300. So the company made an error. When they keyed it into their system, someone keyed in $3,000, not $3,300. So that's an error the company did we need to fix. Then, supplies, repairs. Oh, but look here. The insurance that we wrote a check for $5,400 didn't hit the bank yet. So on the bank side, we're going to show that $5,400. And do you see here, we've got 3 items over here in the bank that the company hasn't recorded. An electronic funds transfer of $4,100, we need to figure out what that's about. A non-sufficient funds of $2,800. A customer gave us money, we deposited it, but it wasn't sufficient. They were insufficient funds. So we need to figure out what customer that was. And then there was a service fee of $100 we need to show in the company's books. Does that make sense? So here, what we do is we show the bank had an ending balance of $26,400. The company had an ending balance of $34,600. Well, items that we need to show in the company side that the bank had, the note received was $2,000. The interest received was $200. The electronic funds were for utilities that we did not report yet of $4,100. The NSF from a customer, we have to reduce our cash. The service fee, and we need to show that advertising expense was actually $300 more than we said, right? So do you see, by adding and subtracting on the company side those items that the bank provided, gives our company balance of $29,500? And do you see, if we take the bank's balance, add the deposits outstanding, subtract the checks outstanding, we also get $29,500? We balance. That is a reconciliation. Okay? So we first look at reconciling the bank side, Then we go and reconcile the company side. We're reconciled when we come together and it equals. Now, the next thing we need to do are these changes that happened here over on the company side. We need to create journal entries to correct our records or to adjust our records to the actual balance. So we'll need to, in this case, show the note was received, show the interest earned, and then show these various, the expenses or the this NSF check. We'll have to reduce our cash and increase our accounts payable. Okay? Because we thought we received the money, we got the money, we deposited it, but it's no good, so we have to show an accounts payable again. Sometimes students mistake an NSF check for a customer as a bad check written by the company instead of one written to the company. When an NSF check occurs, the company has deposited a customer's check, but the customer did not have enough funds to cover the check. The company must adjust its balance of cash downward to reverse the increase in cash it recorded at the time of the deposit. The effect of this bounced customer check creates an accounts receivable for the company until the customer honors the check. So guys, which of the following items would be found on the bank side or the left-hand side of the bank reconciliation? Sorry, guys. Deposit outstanding? Correct. Okay. How would an NSF check from a customer be treated on a bank reconciliation? D, a deduction on the company's side. Excellent, guys. Sometimes students, I already told you that. Okay, so now remember there were items that we adjusted on the company side, but we need to now create some journal entries to record these so our balances match, right? Our cash increased $2,200 by debiting cash, and we credit our notes receivable for the $2,000. So we must have had, we lent money to somebody. Could have been a customer or a colleague, another company that maybe we need their supplies. Who knows? And they paid us interest, and they paid us back the note. We keep the interest separate from the note. Okay, and guys, I told you it was going to be interest income. In this case, they probably already recorded the interest income at the end of the period, and they're just actually receiving this interest here. So this is being treated as a receivable. Then you show all the various items that created expenses. And so this way our bank and book balances will match. In the uncommon event that the two balances at the end of the bank reconciliation schedule are not equal, management then investigates the discrepancy to check for wrongdoing or errors by company employees or the bank. If the company cannot resolve the discrepancy, it records the difference to either a miscellaneous expense or miscellaneous revenue. I mean, guys, in a perfect world, everything matches perfectly, but guess what? Doesn't always work that way. Sometimes it's sense, and it drives you nuts. But, I quit looking, and I just debit it too, like he said. Remember this, guys. Sometimes students try to update the cash accounts for deposits outstanding, checks outstanding, or a bank error. No, we don't have to do anything with those three items. Our books are fine. Just because the bank hasn't received something, we don't need to adjust our books for that. So here is a really important slide. This is how you'll know to do a reconciliation. You start per their balances, bank balance at the end of the month, company's ledger balance at the end of the month. For the bank, you will add deposits outstanding minus checks outstanding and any bank errors to get to the ended number. For the company, you're going to add notes received by the bank, interest received by the bank. You'll subtract unrecorded payments or NSFs, bank service fees, or any company errors. That, remember how the debit card said $3,300, but the company only showed $3,000? That was a company error. So, how would an NSF check from a customer be recorded in the accounting records? Is it D? What do y'all think? B? We would debit accounts receivable and credit cash. Think about it, guys. When we got that check initially, we debited our cash and we credited accounts receivable, right? But because it didn't go through, we're going to do the opposite of that. So we debit our accounts receivable and we credit our cash. Okay. I think what we're going to do is go straight to work on a homework problem. I think some of this stuff is in here twice. I apologize. Okay, last thing I want to talk about is petty cash. Petty cash happens because sometimes there's such small amounts. Sometimes there are small amounts that that need to happen. So oftentimes it's very common for a company to have what's called a petty cash fund on hand, which oftentimes can be $300 to $500. And when they need cash, they use that cash and attach the receipts in there and then replenish the fund. So this is just an example. To establish a petty cash fund, you can debit the petty cash, which is another form of cash, and credit your cash. Oftentimes, there might be needs for employees to purchase various small items. So here's a perfect example of employee purchases. You establish a petty cash fund, you debit the petty cash of $200, credit the cash. Then, let's just say various items happen, things happened, that there was lunch and there was a delivery for the petty cash fund. So we would show those in petty cash, and if these items were purchased using credit cards, that's not part of the petty cash. These credit cards would be in accounts payable, okay? So no, the petty cash fund is used for these items. So we would credit here our petty cash of $150 because that's where it came from. The items purchased on credit cards, they would be recorded here, and you see the credit is accounts payable of $4,100. Okay. Statement of cash flows is a financial statement that shows the changes in cash during the period. We know cash is reported in the balance sheet, the ending balance, and the statement of cash flows also reports the changes in cash during the period. We know our statement of cash flows, and we've talked about this, I think, in the first week, shows changes in operating activities, which is kind of why the company's in business. Changes in investment activities is the purchase and sale of long-term assets or investments. And financing is borrowing money or raising investments like stock or receiving stock. Okay, or paying dividends on that stock. So the statement of cash flow goes through changes in activities only involving stock, cash. So here, as we talk about this Eagle Soccer Academy, you see various transactions, and we'll go, is cash involved or is cash not involved? Guys, if cash isn't involved, we're not going to put it in the statement of cash flows. Here, we sell shares of common stock for $200,000 to obtain funds necessary to start a business. We talked about this in, I think it was chapter 2. Was cash involved? Yes. If cash is involved in this activity, then that will be part of the statement of cash flows. As you see, yeses for all of these but 2. When we purchased supplies on account for $23,000, was cash involved? It wasn't, because we haven't paid the bill yet. Therefore, that would not be part of the statement of cash flows. Also, when we provide soccer training to customers on account for $20, did we receive the cash yet? No. Therefore, that would not be affected, right? All of these other items that do involve cash, we have to decide, are they cash inflows? Is money coming into us, or is money going out? If money's coming in, it's an inflow. If it's going out, it's an outflow. So all of these items we will put into a statement of stockholders' equity. We start with operating activities. Cash inflows happen from number 6 and number 8. Okay, the $43,000 and the $6,000. Excuse me. Sorry, 6 and 8. The soccer training for $43,000. 8, we received cash here of $6,000. So that's 6 and 8. 43 and 8 should be 51. 43 and 6, sorry, 49. So that's the $49,000. The outflows, we go back and look, and we look at operating. We paid a rent in advance, and we also paid salaries to employees. Excuse me. Okay, let me just go here and see. Salaries, $28,000. For rent, $60,000. Those are outflows of operating. So our inflows minus our outflows give us a net cash flows from operating of minus $39,000. Then we have our investing, which is just purchasing equipment, which is a minus $120,000. Then we have our financing, inflows from issuing common stock, inflows from borrowing money at the bank, outflows for paying dividends, which gives us a net increase of $296 from financing. You add those 3 together, you come up with $137,000. This is the statement of cash flows. Which of the following items would be categorized as an investing activity on a statement of cash flows? Awesome, guys. So, this next statement area I'm going to let you do on your own. Basically, I'm not going to go through that right now. You guys can feel free to look at some of these problems here. I would rather, I'm running out of time here, but I wanted you to get an understanding here. I wanted to show you the homework. And we'll get finished here.